Hi, Lachlan Tierney here, and today we'll be talking about how to invest in lithium. If you're here, you probably already know about the electric vehicle boom that is underway, and you know lithium is the metal that will make this boom possible. The lithium market has changed since last year, and as a result, you need to be a bit more discerning when picking lithium stocks. That being said, lithium stocks are still a hot topic despite a recent downturn in the lithium price. Much of this comes down to projected future demand for the world's lightest metal. So a refresher. As you can see, prices across the various types of lithium have declined, but are starting to level out. By 2025, however, demand is set to hit more than 400,000 metric tons. So why the sharp downwards turn? You can see demand is rising steadily. Part of it comes down to supply. In a nutshell, there has been a large set of projects pushed through the pipeline to keep up with demand. Too much, in fact. There are also a couple of factors specific to China, the world's largest producer of electric vehicles by a large margin. The first factor that drove down prices recently was Chinese lithium market players destocking amid tightening credit conditions. This resulted in a flooded market. The second factor was a move by China that took away many of the subsidies for some EVs. They did this to force automakers to innovate instead of relying on credit. As a result, China produced significantly less EVs in the first quarter of 2018 than the first quarter of 2017. But China will be rolling out new incentives in 2019, so prices may well surge again. What does this all mean for investors? For starters, it means that instead of being a short-term play, investors will potentially need to strap in for a longer ride. Major spot price gains may not show up for the next 5 years, according to Moody's Investor Services. We're a bit more bullish on lithium here at Money Morning, though. Crucially, this doesn't imply you won't see major movements in the share prices of lithium stocks. That is, if their projects are forecast to be profitable. Secondly, it means that you need to be a bit pickier than usual when selecting lithium stocks. Betting on the sector might not get you the gains you're looking for. For example, the lithium ETF, LIT, has struggled to return more than 1% on average over the last 9 years. This opens up our discussion to 3 things to look for when picking lithium stocks. Tip 1, know the layout of the market. There's a healthy debate in the lithium investment community about which type of resource will get you the best returns. The 2 types are hard rock lithium and brine-based lithium. As a general rule of thumb, hard rock is more capital intensive, while brine-based lithium is cheaper initially. Relying on evaporative pools, brine is subject to changing weather conditions. There is also the problem of local environmental regulations. Recently, there has been friction between Albemarle and SQM over the levels of brine the 2 companies are able to draw down from their Chilean operations. Chile's water regulator is now considering preparing restrictions on new water rights in the Salar Basin. Operational difficulties such as these provide a window of opportunity for Australian hard rock miners. As you can see below, there is significant projected growth to be found in spodumene or hard rock. In particular, you can see that production will increasingly come from sources other than the big 4 producers. These include SQM, Albemarle, FMC, and Tianqi. Our goal in this presentation, however, is not to profile the big 4 producers, but focus on more exciting speculative plays. To do this, it is helpful to understand the distribution of resources around the world. Clearly, Australia is well positioned with a significant chunk of hard rock global resources. Australia is known for its mining, has a more open regulatory environment, and in general, we're pretty darn good at pulling things out of the ground. In this sense, there's some strategic advantages for lithium miners in Australia, not least of which is our close proximity to China. But Chile and Argentina cannot be forgotten either. Same goes for the US, which has both brine and hard rock resources. One example of a small-cap ASX-listed US-based brine play is Anson Resources. Then, of course, there's the well-known Australian-based hard rock company Pilbara Minerals. And then the Argentina-based brine-focused Orocobre. Another super interesting company is Galaxy Resources, which has both hard rock Australian resources in production and an Argentinian brine project in the pipeline. Let's look at Galaxy Resources for a second. Galaxy looks cheap to us, but the trend is not in our favor here. It is also worth noting that Galaxy Resources is heavily shorted at the moment. Might be one to watch in the coming months if the lithium spot price picks up. So to conclude, when assessing lithium stocks, look at three things. Firstly, where their resources are located. Secondly, the regulatory environment of the country they operate in. Thirdly, you need to know whether they are hard rock or brine-based companies. With these three things in hand, you can then compare balance sheets. Tip 2. Look at current production for metrics. The largest mine in Australia is the Greenbushes mine in Western Australia and ships a whopping amount of lithium. Unfortunately, it is operated by Tianqi Lithium, one of the big four lithium companies we discussed before. However, there have been two major mines that have just begun production. Pilbara Minerals recently announced in October that it had achieved its first shipment of product. The same applies for Altura Mining Limited. So if you're looking for a more predictable investment, it might be wise to consider lithium miners that are already in the production phase. The share price of the company will be more closely tied to the price of lithium, as this is its bottom line. Tip 3. Offtake agreements. For those with a bigger risk appetite, there are a range of small and micro-cap lithium stocks to explore. Perhaps one of the most key announcements these type of companies make are offtake agreements. Offtake agreements are an agreement between a lithium producer and a buyer of their resources for the producer's future output. These agreements are crucial as they make it easier for the producer to obtain financing for the construction of the mine. This is what happened to Pilbara Minerals when it announced an offtake agreement. Given the critical nature of offtake agreements, they provide clarity to investors as to whether a lithium project will actually commence. Things to look for in terms of an offtake agreement include three things: the volume of total resources it secures, any financing made available from the buyer, and processing plant arrangements. Pay attention to company announcements as they complete definitive feasibility studies. This is a common precursor to an offtake agreement. Conclusion: we're in a difficult period for ASX-listed lithium stocks at the moment, but that doesn't mean these companies are all operating on failed models. Lithium prices may well recover as demand firms up. Electric vehicles are the future, and lithium is the exciting metal behind this trend. We hope you've enjoyed the video. Make sure to subscribe to us on YouTube for more information-packed videos just like this one. Also, make sure to check out our report on the lithium market below, which can be downloaded for free. Thanks for watching.